We took 26 strategies and tested over 1,200 variants on Micro ES futures. In this video, we'll be covering the different indicators, approaches, timeframes, etc. that had the most success on MES. If you frequently trade MES, ES, or the S&P 500 in general, you'll find a lot of value in this video in regard to the different trading approaches that were the most successful on this instrument. If you like the content in this video and you want the same analysis done to your own strategy, feel free to visit our website and reach out. With that being said, let's get into the data and see what worked and what didn't. Disclaimer: trading futures involves substantial risk of loss and is not appropriate for all investors. So we batch tested 26 different families or types of strategies, 4 development waves. We had 32 survivors, and at the end of this video, we'll be doing a little bit of a stress validation on these surviving families. Our main question is, can systematic screening find durable intraday edge on MES, or again, ES? We decided to do MES, or the micro version of the mini S&P 500 futures. This is because in our own developing automated trading portfolio, we would prefer to have a large amount of micro strategies with minimal risk in comparison to a handful of mini strategies with a larger realized risk. So our survival rate across 1,200 different variants was 2.5%, meaning only 2.5% of the variants we tested were actually successful and passed our thresholds. Once again, we tested 26 different families, and we tested this on 6 years of data from January 1st of 2020 to the end of 2025. So what we tested and why. So as I said earlier, we're testing MES, which is about $5 a point or 1.25 per tick, and it is a tenth of a mini ES contract. The data is 2020 to 2025, and our session is 9:30 in the morning to about 5 minutes before market close. Our slippage and commission are going to be 2 ticks and then 0.62 per side. This generates a total friction of about $5 to $6 per round trip, and given that MES is $5 per point, there's not a lot of breathing room, and therefore scalping strategies mostly fell off throughout this batch test. Our profit targets were calculated with 0 slippage, given that they were all limit exits. However, the 2 ticks of slippage is still accounted for. The parameters we tested are going to be the 15, 30, and 60-minute intervals. Our stop loss is going to be 1 to 3 ATR. Our profit target is going to be 1.5 to 4. And the indicators are, once again, over 20 families with about 3 to 6 parameters each. If you're unfamiliar with the term ATR, it is average true range. It is an indicator you can apply on a chart, and it essentially calculates the average amount of ticks, or usually points, in a candle at a given time. It is another way to represent volatility. For example, the overnight average true range is going to be a lot lower, given that the candle sizes are genuinely just smaller. The price action at a given moment, either the 5-minute, 15-minute, 30-minute candle sizes, are going to be a lot smaller and less volatile in comparison to the 9:30 market open. Our overall question we're trying to answer in this specific test is, can systematic screening across a broad family set find durable intraday edge on MES? We targeted intraday strategies mainly because proprietary trading firms are very popular nowadays, and they tend to have rules where you can't hold positions overnight. Therefore, intraday strategies work best if you want to leverage your capital. So the families we tested, there are 3 broad categories with 26 individual types of strategies. 3 broad categories are breakout, momentum, and mean reversion. The individual strategies that survived, I will cover a little bit more in depth and define them. For now, if you're curious on what any of these strategies are, feel free to pause the video and look up the individual strategy. We had 4 different waves of testing where we applied a threshold of different financial metrics. In the 4th wave, we added 6 different uncorrelated strategies, as you can see on the bottom. These strategies cover a lot of different approaches to trading, and in the 4th wave, we included different time frames as well as some price action related strategies. So for our thresholds, we take a batch test, which is essentially where we're testing over 1,200 different variants, and we throw away any strategies that have a profit factor of less than 1.2, a Sharpe ratio of less than 0.08 to 0.1, an R squared of less than 0.5 to 0.6, less than 4 out of 6 profitable years, and less than an average trade of $3 to $5. In waves 1 through 2, we tested 640 variants. This was the initial 20 families across the 3 different intervals. In wave 3, we tested 222 variants, and this is where we added our R squared quality filter. In this wave, we actually had 98.6% of the variants rejected, and we realized it was a little too strict. So in wave 4, we added 6 new uncorrelated families, relaxed the profit factor, and we actually tripled the pass rate from doing this. In our final wave, we had a quality sprint where we tightened the Sharpe ratio threshold, we raised our average trade floor, and only 2 were actually able to advance. This batch test was not initially intended to be published. However, we decided that this is a good way to showcase our process in finding profitable strategies for our own automated trading portfolio. These minimum thresholds have a low bar, but that's intentional because we want to investigate any strategy that has proved itself to be even slightly profitable. From there, we can either optimize the data further or look into the category of strategy that ended up working the most. So for the kill rate, we had a total of 1,277 different variants that were tested across our 4 development waves. Only 15 advanced in wave 2, 0 advanced in wave 3, then we added 6 new and correlated strategies and relaxed the threshold a little bit. 17 advanced from there, and in our final quality sprint, only 2 had advanced. The time frame that was the most successful was the 30-minute interval. In our current tests, we'll do 5-minute, 10-minute, 15-minute, etc., and take a much more in-depth approach to the strategy test. However, from generalizing the intervals, we're able to move on to another test in the future with a more focused approach on the 30-minute interval. So for the most interesting part, the families that actually won were the PM EMA cross, the EMA crossover, the Ichimoku cloud, a Williams indicator strategy, and ODC. If you're wondering what these words actually mean, in the next slide I'll define them further. As you can see on the bottom, 21 families that had 0 advances were the squeeze, MACD, RSI, stochastic, etc. Now, does this mean that those strategies at the bottom will never work on MES or ES? Not at all. This just means with our specific parameters, they weren't as successful. Now, if you were to widen the parameters, it's more than possible to see one of the 21 families advancing and having a few successful variants within it. So for the 5 surviving families, the PM EMA crossover, it trades only in the afternoon session from 12 to 3:30. It enters when a fast EMA or exponential moving average crosses a slow one. It filters out morning noise and it captures structured afternoon trends where institutional flow is cleaner. This covered about 34% of advances. The EMA crossover was our second best. It was structured as a relatively standard EMA crossover strategy. However, it didn't have the time frame requirement that the PM EMA crossover did. Our third successful was the Ichimoku cloud. It's a Japanese charting system, but it enters when price breaks above and below the cloud. This strategy is especially strong because there's multiple levels of confirmation that reduce false signals. Our fourth more successful was the Williams indicator. It's an oscillator that measures overbought and oversold conditions, and it uses the EMA 50 to filter trend direction and pick whether or not it wants to go long or short. If you'll notice, there's a little bit of a trend going on here. And in fifth place, we have ODC, or the opening drive continuation. This one identifies strong directional moves in the first hour, so from 9:45 to 10:30, and it enters in the same direction. This strategy is very comparable to the 15-minute orb. However, instead of zooming into that small 15-minute time frame, it actually pushes it forward and tests the price action of the next hour after that. So from these 5, it's obvious to see that the moving average strategies had the most success on MES, which could be useful to know if that's an instrument you trade often. So in regard to our stop and target structure, we saw that the most successful strategies had a stop loss of 2.0 and a take profit of 2.5. I didn't mention this in the beginning, but the numbers in regard to ATR are multiplied. So for example, if our ATR value is 5 points, meaning that during the entry, the average candle size was about 5 points, our stop loss would times that by 2 and automatically place a stop loss order of 10 points. The second most successful was a stop loss of 2.5 and a take profit of 3, with the third being a stop loss of 2.0 again and a take profit of 3. The pattern that we saw was the most successful strategies had targets that were wider than their stops. The best ATR stop loss was a multiplier of 2.0 on the 30-minute interval, and for the most part, any stop loss below 1.5 ATR failed. Coming back to our slippage and commission, a tighter stop loss did not perform well across our given intervals and instrument. Now, if we were to zoom out to a 4-hour interval, our stop loss would be much larger, given that it's going to be 1.5 times the average size of a 4-hour candle, and we'd have a much wider stop and possibly some successful strategies there. So for one of the 2 strategies that passed our final wave was the ODC, or the opening drive continuation, on the 30-minute interval. This was our most consistent survivor. In this case study, we did a very basic walk forward analysis where we optimized in sample from 2020 to the end of 2023, and we tested it forward 2 years. Usually we'd have a lot more steps than just one. However, stress testing is not the topic of this video. Our goal was to see what strategies, intervals, and risk-reward ratios worked best on the MES instrument. So in ODC, we had a profit factor of 1.2, a Sharpe just below 1.0, 836 trades, a win rate barely above 50%, with a max drawdown of 1.1 thousand. As you can see on the bottom right here, we had 6.7 thousand in profit, and our R squared was 0.93. If you've never heard of R squared, it's a performance evaluation method that measures the consistency and smoothness of a trading strategy's returns by calculating how closely its equity curve fits a straight upward sloping line. The value ranges from 0 to 1, with 1 being the best and 0 being the worst. Something to note is that it doesn't always tell the truth. For example, this R squared is 0.93, meaning it's only 0.07 away from being a perfect slope up, which is very much not the case. And the way it's calculated isn't always consistent across different platforms like Python or NinjaTrader's own calculation. Would we move forward with a strategy like ODC? Most likely not. We have to do further testing on the strategy and more than just a one-step walk forward analysis. Our other advanceable strategy had a far worse equity curve. However, I figured we'd highlight it because there was something interesting that came up. So we did a similar walk forward test. Our in-sample Sharpe was actually 0.12 with a P&L of $346 across 4 years. However, its out-of-sample exploded to 1.89 Sharpe with a P&L of 3.3 or 3.4 thousand across just 2. This raised a couple questions. So we did a little bit of research, and there's a lot of different factors that affected this. However, one that we noticed and one that we figured we cover was a slight correlation to the VIX. At the bottom here, we have the VIX 90-day rolling average, which is representative of volume in the market, and we see that at its lowest point of 13 was the beginning of our in-sample period becoming profitable. Now, there are spikes in the VIX, or general volatility, that don't immediately affect the Williams strategy and even contradict it at times. However, as you can see, the volume was much lower in the last 2 years than it was in the first 4, and that's a hint as to why it was so successful. Thinking back to what the strategy is, it's an oscillator strategy which bases its signals off of overbought and oversold levels. In a market where volume is high, those levels are being hit constantly, and there's much more fluctuation in price action. Therefore, the overbought and oversold levels have a higher chance to be misleading. In a lower volume market, it reaches these levels less frequently, making these signals more meaningful when they're actually triggered. Now, with that being said, would I move on with this strategy? Most likely not, but it's always worth noting, and it could be useful in a future strategy. So here's a brief stress test of our top 3 survivors based off of their baseline and out of sample performance. Something you've seen in this video that you haven't seen in the past too is we're not very focused on profit and loss or P&L. When we're doing these large batch tests, our thresholds are not going to be make a certain amount of money across these 6 years. Instead, we're going to look at different metrics that assume profitability without targeting a specific number of profit itself. This is why we're looking at profit factor, our Sharpe ratio, and years profitable, which is a good showcase of consistency. For example, if a strategy performs very well across these 3 metrics and many others, and has a drawdown of, let's say, $500 across 6 years with a total P&L of $5,000, we can leverage that strategy up to 4 to 5 times the amount of its drawdown to maximize the amount of value that we can get out of it. Shooting for just a large amount of profit can push forward bad results and bad strategies that just had one really good trade or one really good month or even one really good year. And we're not looking for a strategy that performs well once every few years. We're looking for a strategy that is consistent and can perform as expected on a monthly basis. And even though the Williams oscillator strategy had a profit factor of 2.25, a Sharpe ratio of 1.8, that performance is not guaranteed since it's slightly based on volatility and is essentially regime dependent. So overall, what did testing over 1,200 variants teach us? We found that 97.5% of strategies in this specific test failed the quality thresholds. The 30-minute time frame dominated with 62.5% of survivors being traded on the 30-minute interval. This emerged from data, not just assumption. Afternoon trading had the biggest edge, contradictory to our previous video on the 15-minute opening range breakout. We discovered that given these specific parameters, morning noise was more of a trap, and that structured afternoon trends are real. We saw that lower risk-reward strategies with wider targets and stops survived more than others, and a stop loss of 2 times the ATR and a take profit of 2.5 times the ATR appeared in 41% of the advances. We found out that mean reversion outperformed in 2024 to 2025, showcasing our Williams strategy. This shows that regime matters and is important to pay attention to, and that lower volume environments come and go. And last but not least, we saw that quality gates must evolve with the data. Our specific thresholds in wave 3 killed discovery entirely and forced us to add more strategies to continue on with the test. In the future, we could either decrease these minimum thresholds, widen our stop loss and take profit parameters, or test different intervals, instead of relying on just adding more strategies when things don't work out. If you frequently trade MES or ES, I hope this video found some purpose. In my personal discretionary trading on MES, I use EMA a lot, so seeing that strategies based around it were more successful has given me a little bit more confidence in my own trading. Now, will any of the strategies that survived move forward into our own automated trading portfolio? Most likely not. We need to do a couple more tests. And from what I've seen so far, they're most likely not. But instead of relying on these specific strategies, now we have a greater foundation for the different indicators, time frames, etc. that worked in this specific environment. If this video has made you more interested in your trading approach across different futures markets, feel free to visit our website and schedule a call by clicking Get Started Anywhere. Here you fill out a little bit of information, whether you want a general backtest, optimization, or a full research report, and we'll schedule a quick 15-minute call to give you a quote and better define what we can do for you. If you want to do this sort of research on your own, just go to the website and click Learn, put in your name and email, and you will gain updates on access to our growing research library, as well as the different methods we use and how we use them. We hope you enjoyed the video. If you have any questions, feel free to email us, go to our website, or drop a comment below. Thank you.